savings. But to get the bonus depreciation, you need to do what's called a cost segregation study. Because when you buy property, that short-term rental, it's 39 years. What the cost seg does, it's an engineered study. They go to your house, they break out all the different components of the house, right? You've got the flooring, the dishwasher, the roof, the foundation. Anything that they consider 20 years or less a useful life, you get to write that off in that first year. But you don't get to just write it off. You have to actually qualify. So real estate, it's typically going to be passive unless you qualify for an exception. And y'all probably know about it. The short-term rental loophole is probably the easiest exception if you're not a real estate professional. You can turn those passive losses into active losses, which can offset your W-2 income, 1099, or business income. But to qualify, you need to follow the rules, and this is where you can take the deduction in year one, but if you don't do it right, 2 or 3 years later, the IRS will come knocking, and they're going to ask for proof. So you want to make sure you do that right, and then also it hits your tax return right too. So to qualify, you need to have an average stay of less than 7 days, and then you need to materially participate. There are a few rules for material participation, but what I find most people, they fall under 2 of these rules. So you spend 100 hours and more than anyone else managing the property, setting it up, all of that. Problem with this one is you have to spend more time than everyone else, and you have to track everyone's hours, right? Or if you got multiple properties, if you're doing renovations, you can spend 500 hours. You don't have to worry about how much time everyone else spends. If you qualify, you have 7 days or less, and you materially participate, that's what unlocks your ability to take those losses and save a lot of money on taxes. So why does this strategy work for high income earners? Well, it keeps more in your pocket. You're either going to get a big tax refund, or if you're smart and you think ahead, and they qualified for over $230,000 in bonus depreciation that first year. So that meant that they paid $0 on their $230,000 of income. That's the highest bracket, over $85,000 of taxes saved. That's right under that 10% down mark, right, with cash flow, the appreciation, and the mortgage pay down though, right, we're over what we paid for. So the IRS loan, they put down $62,000. They put another $125,000 in amenities, renovations. They cash flow that first year $41,000. That's about a 22% cash on cash return. They got a tax refund because it came to me late of $78,000. Someone else, the tenants, they paid down their mortgage, right? They built up equity of $7,000 for that year, and then their house appreciated over 10% of the original purchase price through the renovations and natural appreciation of the property. One problem I see, again, you go and buy a bad deal, right? And this is why I use Skinny, and I recommend my clients to use STR Insights. If you buy a bad deal and you end up not cash flowing, coming out of pocket, you can only hold on to it for so long, right, before it makes sense. And if you went and got bonus depreciation on that property, you had to sell it 2-3 years, you didn't have time to make that money work for you, right? Or you might be in a worse off tax situation, a higher income year. If you sell, you have to recapture anything over that straight line depreciation. So if we got that 5-year property or that 10-year property and you took it 100% in year one, you're having to recapture those 8 years that are left on that depreciation at ordinary rates rather than that 25% recapture rate. So it's very, very important when you buy, one, you make sure that you're in a good deal, and then two, you have an exit strategy. Make sure that you're planning for that sell, because that recapture, we accelerate the deductions too, This is something that I see clients mess up all the time, so y'all definitely want to take a picture of this. Has anyone done renovations on a property? Anybody? Yeah? So if you've done renovations here recently, you want to ask your CPA about a partial asset disposition. What this is when you buy the property and you depreciate it, let's say you got your dishwasher goes out or you need to replace a roof or your HVAC. Most of the time, if you're not dealing with a real estate CPA, you're straight line depreciating that building. You'll see 39 years or 27 and a half years on it, and then they're just going to stick that new roof, the new HVAC, right on that depreciation schedule. And if we have time, I'll show you guys what it looks like. The problem with that is that straight line depreciation is still accounting for that old roof. So you're writing off a roof that's in the garbage or an HVAC that's in the garbage. So you're not getting the benefit of it when you're allowed to actually expense it in the year that you take it away. But it's also a double-edged sword because when you sell, you also have to pay recapture on that old roof or that old HVAC that's been in the garbage 5+ years, right? So you want to get that off your balance sheet, and then you do that through the partial asset disposition. And I've seen a lot of real estate investors, they save somewhere between $5,000 to $15,000 by just deploying this strategy right. Most CPAs, if they don't specialize in real estate, they don't know about it, or maybe they're too lazy to actually put it on the tax return. So if you want to build wealth, reach out to us, scan our QR code, come see me in the booth, Kenny's team as well. Right now I'm offering $500 off comprehensive consult. We'll look at your tax strategy, your estate plan, and your asset protection strategy. We're also offering $500 off any estate plans. And I think I've got around 5 minutes left. So if y'all stick with me, I'll show y'all some tax returns here and what this looks like and show y'all real dollars. So let's see if this works. All right, so this is the first scenario, and this is a typical person, either DIY or they're working with a non-specific real estate CPA. They're making $300,000 a year. They got a rental that cash flowed about $30,000. The problem is they didn't materially participate and they didn't get a cost segregation study done. So they didn't get that benefit of the depreciation. So you can look at line 24 of your 1040. That's where you see how much taxes you're paying for the year. So you see here, this person's paying $51,000, and then they're not getting the benefit of the depreciation. So here's what it should look like. Maybe we can get to it. So this guy making the same amount of money, but he actually materially participated, got a cost segregation study done, and he got the benefit of it. Same $300,000, but check out line 20 or line 8 here. He's got a $128,000 deduction, where before he didn't hit his tax return because he didn't materially participate. So what effect does that have on him? Well, it saved him $30,000. We went from $51,000 in taxes owed to $21,000 in taxes owed just by one short-term rental. And I'll show you all the depreciation schedule. So this is how, if you're implementing a cost seg, this is how your depreciation schedule should look. Some of y'all might just sign the returns, but you really need to be looking at it because you're the only one who's going to care the most about your money. So if you see something like this on your tax return and you want to qualify for the short-term rental loophole, and again, this is where for some furniture, fixings, things like that. So that's an extra $10,000 in savings, year one. So at a 37% bracket on $10,000, you're saving $3,700. But what people don't think about is the recapture too. So that $10,000 deduction actually comes back. It's still on your balance sheet So when you sell that property, you're paying 25% on the recapture. I'll talk after, but you're paying 25% on that recapture when you sell it. And so that's a hidden kind of tax burden where, again, that piece of property is in the trash. It should be off. So once you get it off your balance sheet, you don't have to pay the depreciation. So you save $3,700 in year one, but then you're also saving $2,500 when you sell that piece of property later on. So where this is reported is going to be on the 4797 of your tax return. You don't need to memorize these things, but it's important that you're working with someone who's walking you through this so you know what's going on your tax return, because your tax preparer isn't going to be liable for those taxes that you owe. You are liable for those. So the 4797 is where you're going to show this loss, and it's like a sale of the property or you're abandoning it. And then on your depreciation schedule here, you look right here, you should be seeing anyone doing renovations should see this line right here, assets sold or abandoned, and that 10,000 right there. That's what's going to get it off the balance sheet and also give you that expense in year one. So if you did any renovations, make sure that you see this line here on that depreciation schedule and you've got something on that 4797, or else you might be depreciating 2 roofs, 2 HVACs, or a dishwasher. So that's all I've got for today. Y'all come see me. Like I said, we're offering $500 discount. We work with real estate investors, kind of be an advisor, work with you in all facets of your life, growing your business, buying real estate, and making sure that we have a wealth plan for the long term, and making sure you're protecting your assets, making sure that you're passing it down to your heirs in the right way, and that everything's speaking to each other. So that's it for today. Y'all come see me if y'all have any questions. Thanks.